Hi, everyone. Hello, Warriors. I don't know if currencies go to hell, Shahab. I think people do. How are you? Hi, Zig. Tian, how are you? Everybody. So, good turnaround Tuesday to everyone. Welcome to Face. I was looking for one more low in Euro Pound. I don't know if I'm going to get it. And it's just counter trend here. I could probably launch a piece, but we just missed taking out the 75 low yesterday. I think I'll be patient. I was talking about yesterday when I start doing this, I'm looking all around for something to do. I'm scanning. Um, Nowadays, what comes into my head is there is nothing to force because there'll always be something to do. And the best trade should really kind of hit you in the face. You'll see it. You won't have to just, oh, I got to find a trade today. I got to find a trade today. Well, there aren't good trades every day. And you know what? There aren't good reversals and inflection points and reversals every week. Sometimes you have to wait weeks. Look how long you had to wait. Okay, you're getting a crossing on EG. It's probably going to go. Look how long we had to wait for a dollar top, right? I mean, it took some time and took the formation, but this is a pretty important reversal. So I said yesterday, I can't chase it down here, dollar weakness. But I more than willing to sell a rip back towards 98, 98.20 if we get one. Swiss held a support level. See this right here? So you have some support right here. And I'd say short term, if we got back towards 99.20 or the confluence of this moving average between here and 40, I'm a willing seller. Maybe this is all it has, but I'm going to sit with it. I noticed DSI on the Dixie is down to 50. So it's not that I think all the bullishness is out of here, but you finally get a move and a break of trend, and at least there's some doubt. It's neutral, so it's neutral. So I'm just going to have to sit on my hands here and wait. S&Ps, we have four drives to a top now. So that's a problem sometimes with three drives. You see how well it worked here, at the top and the dollar, right? One, two, three. S&Ps, this is, if we make a new high up here, it'll be the millionth drive to a top. I'm tempted, but there are earnings, and the earnings that I'm waiting for that's, I think, going to decide the market. Last week, I talked a little bit about Microsoft and thought that Microsoft had to make one more new high, which it failed to do right here, and they have earnings. So I think the market's going to turn on what the leader has done because Steve has shown Microsoft during every correction it's been very orderly, and even though the S&P in December of last year, uh, you know, I'm sure it got hit decently at the end of last year. Yeah, this was it. But even this was compared to the S&Ps very orderly. I mean, the S&Ps got all the way back down to, lows of uh, down here. So it held up real well. We'll see if we could get this one more push up out of this, I don't know, triangle. Looks like some type of triangle here. So it's another day that I find myself scanning, looking for something. And the only thing I was ready to do in Euro Pound, I didn't. Something is happening here today, and that's that yields are softening. Okay, so we had a lot of good action up here, and look at this divergence. So we could pull back to 170, maybe even 160. See this? I thought this might be the neckline. Instead, it kind of looks wedgy. So I'm looking for a pullback in yields. We'll see what that translates into. You would think that would happen with risk off, but that's not happening with risk off. And the N is such a toss up to me. You would think that the N would start to weaken with yields and maybe we get one more pullback. I tried it, got out yesterday, haven't recommitted. So um, I'm a spectator today so far, and that's okay with me. There's still that voice in my head saying, you know, you have a lot of people here. They're looking for ideas. That's your job. Well, here is my job is to host and provide some analysis. So I have some ideas. I'll still try and be patient in Euro Pound. We will diverge again if we make a new low. So I'm going to wait and see if we could clean out 75 first. And then, I'm not looking for this in Euro Pound back to 90, but I see no reason why we can't rally back to say 87 and a half, maybe 88, which was the last low before we had this uh, little bear market rally that just really collapsed. So I think we're trying to dig something out in here before we make new lows. And I'm just going to have to be a disciplined guy and see if we could get one more shot down to take out the stops and Euro Pound. If there were any people bottom picking in the last week or so, it's right here under 75 and a half. So we'll see. Oil, you got me, you know, I was looking for more of a rally in oil with the S&Ps. If the S&Ps make new highs, I talked about this narrative. I think we'll get a failing rally in crude if the S&Ps do push up about 30.25 or so. Uh, Maybe we could get up to 57 or so in crude, and that would be a short because eventually I think we're going to get this breakdown under 50 and it measures underneath last year's low at the beginning of this year. So that's what I have. If you haven't done it yet, check us out for a buck. Give you some time of over a week to navigate around and check out the research that is a lot of hard work by the whole team. You'll get to hear Amanda every time you log on. So let's see. I'm looking for a short and Swiss and 3 out of the 5 forms of analysis are negative here. So we'll see what happens here. And I think that's about all I have today. We have an excellent guest, and it's interesting time. Seth Golden has been with us before, but he wants to concentrate on volatility, which, I know Steve thinks that we're getting long-term signals in the VIX because we're not making new lows. If we made a new high in the S&P without the VIX making a new low, that would be something too. But this is what Steve's talking about for quite some time. And we were under the tens, then here was another high, but a higher low in VIX, higher low in VIX, higher low in VIX. We'll see if we hold 12 here. Okay, so something to keep an eye on. I tell you what, if I had $1 million stock portfolio, I'd be buying some insurance with S&P puts, even if we had a new high. A lot of people say, well, it's a waste of money every time I do it. I would have been better off. I spent money for nothing, but that's what insurance is for. Again, you buy homeowners insurance not because you hope there's a fire, but just in case there is one. So that's what I see. Bitcoin, I don't know. To me, it's not doing anything great down here. I still think there could be one more push down, but again, a lack of conviction I have on a lot of things right now. So I'm not going to make something up just to entertain you. Is it an insurance or a tax? It almost never yields. Oh, Seth is here. Okay, so you can answer that, Seth, in about 50 minutes. I'd be interested in knowing how you hedge portfolios if you consider options to be a tax rather than insurance. So stick around for Seth Golden, and I'm bringing Blake in. Blake's been busy writing a blog. He has a lot of conviction about major turn in the dollar. I concur. Not that it matters, but I do concur. And dollar wise, Paulie, if you go to Paulie's webinars, I wasn't at Paulie's webinars, but we had a company meeting, and anytime Paulie brings up a number, you need to pay attention to it because Paulie also is negative the dollar and thinks that we're going to have a hard time getting through. I think his number was about 97.90 or 98. So up there, I'm looking to short Swiss and buy euro. Maybe I'll be long EG by then. So Paul Franco, you have to check it out. He does one free webinar, and the European crossover, you have to be a member to get Paulie's numbers, which are you always see some type of nice reaction from Paulie's numbers. So this one's for free. 97.90-ish in the Dixie is going to be a major obstacle on any
I
recovery.
think it was 97.86.
Oh, was it 86? Oh,
yeah,
okay.
and I have a very similar number, if you remember, 97.70. So not big of a difference.
Okay, you're not that a day away, or who knows?
Perhaps an
Anyway,
hour
I hope
away.
I hope it gets in the area, anywhere in that area. I kind of favor shorts and Swiss. I kind of like the way it held to give people some false hopes here, Steve. Maybe I'm wrong. Maybe it's more than false hope, but you see where it held right here. So, people are saying double bottom and they'll start buying it and they'll be dropping stops under these lows. But if I get another shot up here, I'm going to take it because the weekly to me looks like we have a chance to trade down towards this level. Shade under 96 is my swing target for US dollar Swiss. So thanks for filling us in on Paulie's number. And now we could get some ideas on looking at Blake's charts. That's a great thing about this community, guys, is I could walk in here with a clean slate and not know what to do. And then after listening to the team present their views, I pay attention. I watch it. I don't just host it. And I can't even tell you how many times I've come in this way. And by the end of face, I have a lot of compelling things to consider and take a look at and possibly trade. So, Blake, give us ideas.
I wish I was full of them today.
Give us free ideas, Blake, and so people could complain that you didn't give them one other idea.
Well, not a lot's changed. Let's start by talking about that the market's actually quite, the market's very much unchanged from where it was yesterday. It's been actually a very slow night. The euro's ground down a little bit. The dollar's kind of pushed higher against most major currencies, and that was to be expected, and it's still to be expected. We have we had some very overbought conditions, especially even the euro. You can see the euro's working off those overbought conditions right now. The Aussie was doing the exact same thing. We were very overbought here on a 4-hour chart. Kiwi, same thing. So we're working off some of those overbought conditions, but I don't think the trend has changed at all. Matter of fact, you were talking
pretty
about
shallow so far, bro.
They're very, very shallow pullbacks, and frankly, when you're talking about like the euro, and I like to reference the euro pound a lot. A lot of people talk about the major currencies as being the most liquid currencies out there. Well, when you take the eurozone, and then you take the the UK economy. Those are two of the largest economies in the world, and when you have the euro pound, there's a lot of liquidity that goes through there. The euro pound has been beat down pretty aggressively because of
Oh yeah.
Brexit. So if we start to see a turn in the euro pound, that's going to inadvertently support the euro dollar to an extent. So the pound could drop below 129, the euro dollar might actually go higher, and you're going to go, well, what happened? Well, that could be that the euro pound is making a move. So keep an eye on the euro pound, especially if the euro pound starts breaking above like 86, you know 25,
25, yeah.
yeah, 20, 25, 30. You're going to start to see the euro firm up a little bit. And I look at the euro, and the euro is just pulling back to its trend line. We're in a pennant formation. You look at that candle and you go, oh my god, that's such a bearish candle. Yeah, it is, but you know the, then again, we're pulling back to some pretty key support here, nice little consolidation area. So I wouldn't get too terribly excited about, euro downside, even though that the candle looks, pretty bearish right now. It doesn't mean that we can't, drop another 5 or 10 pips and then bounce. And I'm, like I said, I'm not overly excited about the market because not a whole lot's moved. I mean, when the euro's got a trading range of less than 30 pips right now, it's hard to get super excited about the market. Everybody's waiting for this Brexit vote today. I'll bring in Stelios here in just a minute to talk about it because it's still quite a disaster. Everything that's happening, but you can see the pound that's pulling back right now, and it looks like at the moment Boris Johnson does not have the DUP on board because of his timeline. He's got some accelerated timeline that he's trying to put forth, and the DUP doesn't seem to be on board with that. So more shenanigans as far as the UK goes. And like I said, I'll bring Stelios here in a few minutes to talk about it. But if you look at let's take a look at some of the other majors. So the
I
euros,
believe, Blake, that Andre has a pip working in euro pound too.
does he?
Yeah.
I haven't looked this morning.
Yeah.
Haven't
I'm pretty
there yet.
sure he does. And he called the break too. So, he's kind of been in the zone on, sometimes, Blake, do you ever find like there's an instrument that, both you're trading both directionally on both sides of the market, and you kind of have a real good feel for what's going on?
Yeah, absolutely.
And do you stick with it when you have that rhythm where,
I do.
Okay.
A lot,
So I'm
actually.
noticing Andre has that with EG right now.
Yeah, when you feel I guess rhythm is a good way to put it, because but back in the 90s, I traded with this and this is, you bring this up, and I like to talk about this because it's so true. This I'm not a musician. You are. I'm not musically inclined, but in the 90s, I traded with this guy. We used to call him Maestro. He was the Mesa Symphony conductor
Wow.
in the city of Mesa, and he that was like what he did. But he was managing his family funds, and ran into him probably about 10 years ago, and he was still trading. He trades equities. This is, and this is way back when. Ran into him about 10 years ago, and he was still, trading equities, managing his family's portfolio. But he was always so good because he understood rhythm, and he always would convey to me that the market is very rhythmic, and that's why he really took to the markets, is the the ebb and flows, and he just catch the ebb and flows of the market like music. And
They're
so
good mathematicians too, all these professional musicians. They see the
typically
math in it.
typically yes
In music.
they do. And he was pretty instrumental back in my early days back in the 90s of not necessarily learning Fibonacci's, but practicing them, because he was a Fibonacci trader as well. Back when been when technical analysis was more voodoo than anything. So anyway, I guess going back to your original comment is that, yeah, that's why a lot of traders really focus on, they're like a couple of different instruments, because they tend to find that rhythm in the market and they'll stick with it. The one thing I do want to caution is that, when you're trading a market, and you're, whether it's the Aussie that you see here, or whether it's, you know Microsoft, I don't care what it is, whatever your whatever
Yeah.
instrument you're trading, just be aware when the markets are trending, probably less than 20% of the time, 85% of the time we're range bound. So the rhythmatic focus in the market can work a lot of times, but when we break out and we start trending, you have to be able to recognize that a trend is developing, and you have to kind of let that notion in your mind sit back a little bit and take a back seat to what you're witnessing as a trend develop. I think a lot of that came in play with gold. For many, many, many years, gold traders would just, they'd play the rhythmatic formations of the market, whether it's got overbought, and so I'm going to fade it, but then we broke out this summer, and I saw people get run over like freight trains, trying to fade this really, really strong trend that we have in gold, and that will happen, not all the time, and less times than not, but you have to be aware of when trends start to develop themselves, and then also know when to stand aside and not not to succumb to those desires of constantly fading overbought or oversold, which that's where traders end up getting into trouble, because they just think that all markets are range bound all the time, which they're not. Now, speaking of which, so we have the euro, and the euro is developing. It has a really, really big breakout that is consolidating. We had a huge move last week. We're now consolidating those gains, and my 2 cents is, as long as we stay above 111 on a closing basis, the risk is that we continue higher. Now, I really would like to see a move above the 200-day moving average to confirm that. That's also a 618 retracement of this last move lower. You can see right here. You can see this fib. All right. So 618 really comes in at the 200-day moving average, and a break above that would be very bullish, in my opinion. We have this like flag pattern that's developing, and I'd like to see, or it's like a pennant. I'd like to see us break above 111.50 before I get too terribly excited about this pennant, whether it's this or whether that is more like it, is to be seen. Depends how long this flag, the flag part of the pennant, plays out. But I do think that the euro continues to be bullish while we're above this, like I said, 111. We might get as low as like 111.10. And that depends a lot on like the news that happens today. Now, speaking of today, I'd like to bring in Stelios really quick, because we're talking about Brexit, and the Brexit vote this afternoon or this evening could really alter the cable and probably move the dollar somewhat. And so, Stelios, if you're here.
I am. Good morning.
Hey, good morning. Like to hear your comments regarding what's happening in UK Parliament, if you have any idea.
Yeah, I was going to say thank you for putting me on the spot to explain something that nobody understands, basically. No, I mean,
if there's anybody that has any understanding of it, would be
it's Amanda, actually.
She won't speak. She refuses to get on the webinar because she does. But anyway, go ahead.
I mean, she has actually helped me understand, because I was completely lost at some point. But basically, what we have is the following. We have, in principle, an agreement between Boris Johnson and the EU. This has to pass through Parliament. But before there's a vote on this, there has to be a vote on the withdrawal agreement bill, the WAB that everybody refers to. And this is a big document that says exactly how the whole deal is going to be, details of exactly how it's going to be done. And the interesting thing is that this is a document which I think is 100 and something pages, and it was made available to MPs last night, I think, and they have to vote on it in about 5 hours from now, or something like that. So, and it's not going to be an easy text, right? It's not going to be a little story. It's all
right, because the time's running out. I mean, we got till next Thursday.
Yes. So there are two things. First of all, this has to be passed. The timing of this has to be passed, and because most MPs just don't have enough time to read it, right, and to understand it, to make a decision on it. The general acceptance now is that it's not going to pass, and it kind of makes sense. Now, the interesting thing is that if this vote today does pass, then it seems that Johnson does have a majority to actually push through the agreement. So it's almost a done deal, but it cannot be done yet. So I think the way things stand, my opinion, it could be completely wrong, is because of this really strict timetable, the most probable event is another extension, because we're very close to the date now. As always, they've left it right to the end, and we are counting hours here and hours there, while we had 2.5 years to get through all this. It's very frustrating. I'm sure it's more frustrating for UK people. I really feel sorry for you, but we have to make some sense of it. But at the moment, like I said before, the most probable scenario, I think, is another extension. And then what happens? Well, who knows?
And I mean, maybe there's another general election, and
maybe.
it is a mess, and I think you're right. Everybody's looking that past today, saying that we're going to have to get another extension, because it's not going to, the bill's probably not going to pass today. DUP is not on board with Boris Johnson's timeline, and to be honest, having a very short period of time to review, and then we're coming up to the to drop dead date, which is just about 9 days away. It's like trying to, how many times have we seen this with Theresa May trying to cram legislation through Parliament, and it just get rejected. So
I fail to understand why this is happening. I mean, everybody knows the timetable. They know when the dates are, when the first original withdrawal date was in March, now October. Why is there this complete lack of anything for weeks, and then suddenly it's all kicking off? I mean, they're intelligent people. They know what's coming. Why isn't this taken care of earlier? I just don't get it. I don't know what the ulterior motive is, but I cannot accept that they're doing this by accident. It's just my opinion. I don't know.
Well, maybe they're not. Maybe there's a big grand scheme of things happening. But hey, thanks for the input, Stel, and I love putting you on the stops. Nobody understands, and it's good that those of us that don't understand try to make sense of it anyway. So we have Canadian retail sales. I bet Steve is here. I'm going to stick with you guys through the retail sales really quick through Canada. Trudeau did win. He is, but he's continuing on without a majority. So I think he's, building a coalition government right now. The dollar Canadian, if you guys haven't seen it, the dollar Canadian is sitting on from a 2012 trend line that spawns back all the way to 2012. If you use Forex analytics, you knew not to get too aggressive down here. You knew that we were coming down to this the 127% extension at 130.75. It was a big deal. We came down, hit it. I think this is going to be really big support. I don't know if about the retail sales as far as the strength of the Canadian retail consumer, but we're about ready to find out. 0.4% is what we're expecting on retail sales, core retail sales at 0.1%. I doubt we're going to have, even if it's a really strong number, I doubt it's going to be enough to actually push us through this trend line. The only thing that, looking ahead, hold hold on, let me check how many seconds. We have just about 15 seconds here. Only thing that's going to break us through that is the passage of USMCA, in my opinion, and that might be the catalyst that drives us below that trend line. But you look at the way the dollar Mexican peso is trading; it's trading really heavy. So, all right, retail sales are out. They are weaker. So, yep, they are weaker.
Revision
You
slightly higher, but yeah, no, they're weak. They're weak.
Yeah, they're generally speaking pretty weak. So the dollar Canadian is getting a bit of a lift here, and actually, the one pair that it was our chart of the day yesterday was the Canadian yen, noting that we'd hit the 161% extension right here, and that was going to be pretty big resistance, the 161% extension, and also the resistance from back in July. And we came right up there and reversed. I don't know how super excited I'd get about fading that, but if you cherry picked a top up there, hey, that's a great place. If you did short it, just move your stops up to break even, and hope for a no Brexit deal ever in the face of in the history of the planet. And if that's the case, the dollar Canadian or the Canadian yen might actually work out for you pretty well. But anyway,
nice,
I think
nice ascending wedge as well there. I saw that actually in the chat room yesterday, Blake, that might be a formation that
yeah, something looks like that. Yeah, and that might give us a pullback towards and all jokes aside, probably like 82 and change, like somewhere down here. I think this is doable. That's doable. Coming out of this wedge, if it does break a little lower, but equities are still strong, Steve. They're ridiculously strong. I'm obviously just like anybody else. I'm so skeptical, but the market continues to climb this wall of worry, and I don't know what the catalyst is going to be that could drive us higher. But man, if I was short equities, which I'm not, but if I was short equities, I would be nervous up here. A break above 30.20.
Last year we had a record number of buybacks, no surprise there, and so far today, not to date, so far this year, first 2 quarters, so first 6 months, we've already tied that. So one of the reasons is this huge buyback bid that we get in the market, huge, enormous.
Yeah, and it continues to
accelerate.
Accelerate, and so I've always been in the camp of hoping for a blow off top. I would love to see some sort of just a 5-6% move higher in equities and a complete utter reversal by the end of the day. I just don't know what's gonna create it, and I don't it's not like I'm hoping for it to trade it. I doesn't mean that I think necessarily, or I'm not betting on it for it to happen. In other words, I'm not like long equities right now expecting some sort of blow off top. I'd just love to see it, because whenever you see a capitulation type of move, that always marks a high or low in the market. And I've seen, maybe in the last 20 some odd years of trading, less than a handful of them in my time. So it's not something that happens often, and it's not something that I've seen since probably crude oil years ago. And I don't know if you can really count the Swiss National Bank, because that was more of a liquidity issue versus major market move. But I think it'd be nice. It just to know that the top side of the market is capped. But we'll have to see. But like I said, if I was short equities, I'd be a little nervous here as we are nudging up against highs. Risk reward favors shorts here. I know volatility is low and it's not hitting new lows, which is divergent, but still, is it worth sitting in front of standing and trying to stand in front of this freight train right now without seeing lower lows on equities? We continue to see higher highs and higher lows as far as equities go. So stand in front of it at your own mercy. So, but good morning, Steve. How are you?
Good morning, Blake. I have a little bit of a migraine, but
Yeah, that's what happens when you try to nap midday, right?
yeah, but you don't have many alternatives if you have to go off coffee.
I know. Are you going off coffee? See, that's
Not a choice.
doctor says no more coffee for you, huh?
My
Wow.
stomach said that no more for a while.
Oh man, that's there's got to be like caffeine pills, right? Isn't there?
Yeah, but caffeine is forbidden if you have like gastritis or whatever, regardless in which form you take it.
Yeah, no
Yeah.
wonder it's like probably sticking an axe in your head. Well, I hope it subsides. Nothing like a little bit of aspirin or Tylenol or some sort of pain med might help out a little bit. So.
Aspirin probably not a good idea. It's like nuclear bomb for the stomach. But yeah, there are other pills.
I wonder if crystal meth would affect your stomach.
That might actually work.
And something, I've never tried it. It's a good opportunity.
You'd get a lot of work done for about a week. The German army used it. It was in pill form.
The German army used a lot of
in World War II.
things.
Yeah,
a lot of things.
So that's how they were able to do all these blitzkriegs. These guys would fight for 3, 4, 5 days straight.
They did.
In World War II. We used they called them bennies to keep the soldiers up. They didn't have anything like that for you when you were in the military, did they?
They did. Unfortunately, actually, fortunately, one of the very, very, very few positives of war is, wars that they've helped medicine progress forward. For example, the Nazi Germany, made a lot of progress in surgery having to do with fractures, etc., because they wanted to, send troops back in the field as soon as possible. But obviously, it would be rather preferable if it took us more time to develop those techniques and not have, tens of millions of people dying.
Well, the only thing that we had going for us in the military and being an infantryman in the Marine Corps is they just had Penthouse and Playboy. They just showed us that and said, if you want to get home to this, then you have to go out and do
that'll work.
Anyway, all right, guys. Well, hey, I'm going to pass it over to you, and you guys have a great day. Let's hope for some fireworks today with the UK Parliament, because this lack of volatility is.
When do they vote?
I think it's like Stelio said, it's like 4 or 5 hours from now. So
okay,
yeah, and, we'll see.
Yeah.
All right, guys. Have a great one. Thanks everybody for tuning in. Remember, if you haven't tried, thank you. If you haven't tried Forex Analytics, try at least the light version. Try it out. You get access to the full version for 10 days, but try it out.
Yeah. Plus, if you're not sure you have the ideal broker, for the type of trading you do, or even, if you think you've already found it, you can still speak with Forest Park Affection. They can, help you out, guide you, and if you sign up with them, they can, in essence, subsidize, sponsor your Forex Analytics subscription, or give you cashback if you're in the US. I strongly suggest you speak with them. They're real pros in what they do. I'm one of their clients, so I'm a very satisfied client.
All right, buddy. So, what are you seeing here today, Steve? And I think there was actually chemotherapy that they use on cancer patients evolved from chemical warfare.
I'm not sure about that, but it wouldn't really surprise me.
Yeah, it did.
But unfortunately, a lot of the progress, went through experimenting on prisoners of war. Yeah. In the case of World War II, as you understand, big majority being Jews, knowing that Hitler had a thing for them. Anyhow,
let's talk.
Very sad chapters of human history, but let's hope we never have to go through them again, ever. Let's see what questions we have. Good morning, good morning, good morning, good morning back to everybody. 97. Okay, so initially let's just mention. So let's start from the DXY, and so what exactly we're looking for in the case we do have a rebound, because in essence now the whole conversation is okay. I mean, we've seen the DXY stabilize yesterday, and we're seeing an attempt to rebound here. So where can this take us? And Paul is looking for 97.86, if I remember right, and I can see why it's that low there. These lows there. Personally, I think 97.70 is quite an important zone. So I want to see if a retest of 97.70 is going to reject price action. Now you can't be certain about that, but I can tell you that I'm pretty confident that any type of rally that we get here is going to end up getting sold now. Might be at 97.70, might be closer to 98. Worst case scenario might be even like 98, like 30s. Okay, but I do believe that we're going to see a continuation lower. I still think that there is a very high probability that we're going to retest this blue ascending channel. So having said that, and this way we can put in perspective what we're seeing here in the euro and the pound and the Aussie and the Kiwi. So we're seeing pullbacks. Now I'm not sure if 111.10, which was the resistance, is going to prove enough of a pullback to provide another leg, the beginning of another leg higher for the euro. I mean, my only problem with that is it's rather low. It's rather close. Sorry. So it might need to correct more. But another level I would be looking for in that case is 110.70. Okay, so but I do believe that it's very, very likely that this pullback in the euro is going to be bought. Now, having to do with the pound, wrong place to open the chart. So having to do with the pound, there you go. We're seeing another rejection from 130. So this is like the fourth day that that the market is testing 130, and it seems to be getting rejected from here. And obviously, if we don't have like some positive developments today, this move lower might accelerate. And I think it's healthy to see a pullback, after such a huge move higher. But in any case, as I mentioned yesterday, if you remember yesterday specifically, I said, would you be buying? I mean, the cable can squeeze a lot higher from here, but would you be buying cable at 130? No chance, because it's a round level, so a psychological level, it's horizontal support resistance area, and we're also very overbought. So I'm hoping that we might get a move lower unfolding today, and ideally I would even want to see the pound come all the way down to 126.50 and retest this broken descending wedges resistance as support. So that would be an ideal scenario for me personally, unless the move lower is like extremely strong, like we go there in a day or something like that. I'm going to be buying that. So if we move lower in that level in an orderly fashion, I'm going to be looking to buy the pound down there, and probably more pound pairs as well. Pound yen also has stalled a little bit higher than the 61.8. If you remember, we also showed yesterday. I'm showing all that again because we have important we have an important event today that might move the pound. Pound Aussie, another day of consolidation. This is a very rare event, by the way. Look at this. We're now in the third consecutive inside day. So we had an inside day, then we had an inside day to an inside day yesterday. And so far today, we have an inside day to an inside day to an inside day. Very, very rare. So, usually when you get a breakout after such a consolidation, you usually get follow through in the direction that you break out. And don't forget that the pound also got rejected from a very important trend line resistance, right? You can see it here. It's the trend line resistance from this expanding triangle. And also, pound kiwi also got rejected from confluence of resistances, horizontal support resistance area, 127% extension, and this ascending channels resistance. Watch 2 as support, nice round level, also horizontal support resistance area, and this channels support. So, if you want to be buying the pound kiwi, 2 is a nice number to try to do so. But as I said, depends on what happens today. We might see the beginning of a deeper pullback for the pound and the pound pairs. But I'm going to keep repeating. I think that if we see a pullback in an orderly fashion, we can even move lower, like 300 pips, and still, and I would still consider that as a buying opportunity. Now, economic news. I think we covered that. We only had Canadian data, and of course it's all about the pound today. SPX and UJ cannot fall. Yes, but on the other hand, I mean, yes, the SPX remained extremely well bid, and yes, the USD yen isn't falling from here. Anyhow, we've already indicated the importance of this 108.40, 108.50 area as an area previously acting as resistance, now acting as support. So as long as we stay above it, the path of least resistance should be higher. So I wouldn't be surprised if I see another leg higher starting from here towards the first area of resistance is 109.36. It's the 61.8% fib, but we have levels above that. But I have to tell you that I don't like the fact that USD yen seems to be very frequently, it's spending many days not responding more or less to anything. I don't consider this currency's behavior very normal. It's in many different aspects kind of, manipulated. So personally, I'm not looking to buy into it. Although if I had to trade it at the moment, I would be buying, against, yesterday's low, for example, right? So it's a very appealing from a risk reward perspective opportunity. You want to risk like what, 30 pips in case we move higher. Okay, it makes sense, but personally, I'd rather be trading other stuff. And as I said, if we get lucky, I think we might be getting an opportunity buying several currency pairs against the dollar within the next few days. Now, specifically having to do with the USD CAD, since we did have Canadian data today and they were weak, and we are seeing a nice rebound here in USD CAD, keep in mind that the first area of resistance is not far away. It's actually quite close, and it is the 131.40 area. Multiple resistances can be found here. So I do think that it might even be worth a shot trying to short that if you're looking for more dollar weakness from here. So 131.40 channels broken trend line support, horizontal support resistance area. In the recent past, I think it's a decent level to look for a reaction from. Now, having to do with the metals, it was quite an interesting day yesterday for silver. And I wanted to mention that because specifically yesterday I was talking about the interesting potential development of a breakout in silver. But as I mentioned, as long as we ended up closing above 1775, we were trading closer to 1790 actually at some point in the day, and then silver gave back all of its gains to close the day unchanged. So an attempt to break out, which was clearly a failure so far. That's obviously not a bullish signal. Of course, on the other hand, we've spent quite a lot of time trapped between 1725 and 1775. So, on the other hand, I wouldn't be turning bearish, not unless we break below 1725, in which case, especially, closing a daily close below 1725, in which case I would be looking for a more complex correction lower. But I would still maintain my bias that these move lower that we've seen both in gold and silver are corrective in nature. Gold didn't produce, by the way, yesterday a false breakout, as you see. Actually, gold never even attempted to follow silver higher on the day yesterday. Gold also still looking like
show them the gold silver ratio, and it looks like we're headed for new lows, doesn't it, bro?
Gold silver ratio actually had a very nice candle up to a point yesterday, but with the reversal we had in silver later in the day, that candle ended up being a pin bar, and so far today an inside day, so it's still not an easy chart to read here. Okay, I would still favor more downside in the gold silver ratio, but I'm not sure if it's going to happen from here, or perhaps, as I expected earlier, from a little bit higher. So I wouldn't rule out a move.
Isn't that always the dilemma?
Yes, it is, until it stops being the dilemma. I'm saying that because you get opportunities from the market that you get a big reaction from an important zone, and then although it's quite early, you still have very high conviction that a move has started lower again. For example, let me remind you one recent example that we had in that. I posted actually for that an intraday update. I also posted it in the chat room. It was just a few days ago. It was in the Europound, and it was here. So I was looking, if you remember, Dale, this rebound to be corrective in nature.
Yeah.
And then we got that huge reversal. And even before we closed the day, once we came down and retested this channel, and we already had in our hands a huge outside black candle.
Yeah.
It doesn't matter that it ended up being even greater by the end of the day. I then said, okay, that's it. The Europound is now resuming lower.
So wait for strong signals.
Yeah. Why did that happen? Because I already had quite a high conviction that this rebound that was unfolding was corrective in nature. And then you get like a very big candle unfolding exactly at the limits of what you would expect this rebound to reach. And once you see that, and that these type of candlesticks very, very rarely get reversed like next day. It's more frequent that what they will end up producing is a follow-through day like the one we see here. So we had a huge candlestick that day, and next day was another huge black candlestick, and 2 days later we had another one of those, right? So these are examples. Of course, you don't get those opportunities on a daily basis, but these are examples that you can be fairly confident that something big is happening, quite at the beginning of that move. Of course, as I said, it's a luxury. It's not something that you see every day, but when you see it, you need to take advantage of that. Wall Street wasn't built on equities going down, nor does it exist on equities going down. That is very, very true. Not only that, the economic recovery is totally dependent on asset prices. So, in the past, when we actually had healthy economies, you could actually end up seeing a big move lower, not really causing, an economic, a financial crisis, a big recession, But nowadays, that is actually almost impossible, because if we do get a big move lower in equities, it is more than certain that it's going to lead, even if it's not the result of, it's going to lead to a recession. Okay. Let me see what else. Okay, so we did cover USD CAD, and Blake mentioned it. I would have shown it, and here is what I have here on my chart. Here is since we were talking about the CAD, here is the CAD yen ascending wedge. I actually showed that yesterday early in the chat room. I showed two charts yesterday in the chat room because they looked very, very similar. One of them was CAD yen, saying that it looks like an ascending wedge to me, and you should be a little bit careful here. It looks good to the upside, but you should be careful seeing this type of information. We might have a pullback. And the other one, which I said was very similar, was, there you go, the pound yen. And you can see it here, right? As you see, they look quite similar. So, the pound yen might also play out very nicely if, today's vote, leads to a bigger pound decline. So I would be quite careful with those two. Coach, we do have a guest today, right? And he is
Yes.
already here, right?
Yeah, yes.
Okay. So let me see what else we have. Just a brief mention here in the S&P. Keep in mind, we're now getting quite close to the first area of resistance. First area of resistance is actually, if you want to look at this as a triangle, you have resistance like at 30.20, 30.21. Okay. Now, on the other hand, if we do break above it, and I showed that yesterday, keep in mind that there is also a higher resistance area, which you can see more clearly here on the daily, because you can view this as a big ascending wedge, in which case resistance is passing from 3050, right? 3050. So these are the two areas to monitor. I really think that anything that happens in between 3050 and this trend line support is noise. So yes, you need to keep respecting the trend until proven otherwise, and we might even see a breakout from 3050 and another thrust higher. Personally, I will be looking to sell that. I mean, if I see a throw over from this wedge, I'm going to be looking at that as a terminal type of move. But I do think that anything that happens in between is purely noise, and it can go either way, right? I mean, RSI is still diverging. There's no question about it. You can see it here in the daily and in higher time frames as well. So I think that having to do with stock indices, you need to be patient. Okay, Coach, why don't you go ahead and start the interview?
Okay, thank you, Steve.
My pleasure.
All right, so Seth, welcome back. I'm going to promote you to panelist. And then I'm going to unmute you. Okay, Seth, welcome back, buddy.
Hi, good morning, Dale. How are you, sir?
Good, buddy. So welcome back. And
thank you.
What interesting topic that you selected today, talking about volatility and the lack of, and we've been talking about for quite some time. The VIX has been making higher lows despite new highs in the S&Ps for about a year, when we were trading under 10, and they are higher lows.
Right.
And we're getting into an area where if the S&Ps make new highs and it's not a huge acceleration, it's really going to be a test for the VIX to see if it can hold this 14, 13 area or wash out. What are you thinking? And you can share your chart by just hovering your mouse over the menu and you'll see a green box that says share, and there you go. Okay. So
Yeah, I tend to look more closely with regards to your, your considerations on the VIX making higher lows. The way, there's various ways that you can look at a VIX chart. I tend to not favor looking at, a VIX chart simply because it doesn't work within my trading paradigm to, perform technical analysis on the VIX. And over the last 8-9 years that I've been trading the VIX complex, it's more or less a depiction for me. The extrapolation from a chart is simply a depiction of what I've already discerned from the macro outlook. And, the VIX is just telling me it's moving from one regime to the next. That's typically what the VIX does. We saw in 2017, all-time, low on the VIX. We saw an all-time low median on the VIX as well at 11% for the year.
Okay.
And then from that period, you go to the next volatility regime, which, was 2018, elevated, significantly above on the median and mode, the VIX above the 2017 level. So here in 2019, we're in another volatility regime, and volatility regimes can last anywhere from, 6 months to a full year. But we're in a calendar year where we're below, the volatility levels thus far on the median VIX that we were in 2018, and we're pretty consistent with regards to what you tend to see during an easing cycle. And I know it's kind of a faux pas right now to suggest this is a Fed easing cycle based on the language they prefer for us to use, maybe. But that is, what we're seeing in the VIX is typical of what you do tend to see during an easing cycle, which is extended periods of complacency or relaxation, lower level readings on the VIX.
Seth, I've been asking a lot of people that have been coming in, our guests, what they believe is really happening in the repo market. I know that, you're a student of the market, and the explanation was, it's technical. At first they gave reasons like large corporate tax payments. I suspect that there might be other reasons why the banks would bid up funds in the overnight market, why they would, even with, like you're saying, the Fed's easing, why would they need to even scramble for overnight funds?
Yeah, I don't necessarily buy into some of the explanations that have been, fettered about.
What do you think it is?
I think there is serious considerations of what's going on in the corporate bond market. I think that there's a problem out there. I think the Fed has to, at this point, rationalize and kind of step in and expand their balance sheet and basically support there's no other way to describe it, but when an event like that happens, there's obviously a crack in the foundation.
Well, doesn't that kind of fly in the face of the narrative that in the last financial crisis, the Great Recession, which wasn't great for anyone but the banks and people that bet on the short side of housing, that the banks had cleaned up their balance sheets here in the U.S. And we've been saying, see, we took care of things. There's no systemic risk, whereas Europe did not. And that's why Deutsche Bank and other banks are having problems.
Well, and I'm sorry to interrupt. Systemic risk basically just moves from one aspect of the financial system to another, and it evolves through product. We had the CDOs back during the mortgage meltdown, and now we have
it's corporate bonds,
right, and leveraged loans.
Okay,
and I think these are kind of the newfangled CDOs, if you will, or a bubblicious type activity that's going on that is starting to rise to the surface. So I don't think we ever solve human behavior. You know, we don't necessarily correct the behavior. We don't, you know, we never took our medicine, so to speak. So we look for other areas to express the same human behavior within the financial markets, just in different assets and using different leverage or amounts of leverage. And I think that's basically what is surfacing in the here and now through the leverage loan market.
Okay. And what are leverage loans? Are they for possibly some of these unicorns that?
A good deal of them, yes. And a good deal of it is, you know, you can find in, you know, some of our more heavily indebted companies and those that are at risk, such as, you know, General Electric, which we saw cause a bit of a stir, a bit of you know, credit spreads started to widen when we had headlines on GE and, you know, some of their leverage loans defaulting. So it's a problem I don't know necessarily that the Fed has their handle on just yet, but they, you know, they're moving into position, so to speak.
Okay. All right. So you wanted to talk about the VIX. So you're talking about we're in these new regimes. There's only a few months left of this year.
Correct.
Do you think the regime stays status quo through the end of the year before we get a new one?
By all measures and all the indicators that I look for, yes. Principally, you know, when we, you know, we're looking at a global slowdown, a global economic slowdown, even a domestic slowdown of sorts. And I try to focus on the rate of change because that's really the biggest headwind, you know, moving from one year to the next, from one regime to the next. And what we like to see is estimates coming down. As estimates come down, they present themselves as a lower bar for corporates, you know, basically to leap over. Combining that with the Fed easing cycle, and financial conditions remain basically at cyclical lows. All of that is the recipe that we look for, a continuation in this, you know, lower volatility regime through the year end. Essentially, we should see tail risk abate. We should see hedge funds, institutional participation start to leverage up their risk exposure, especially in a low rate regime where you're also going to have end of year pension fund rebalancing. You know, commit, you know, more to the risk on you know, portfolio than they are usually allocated. The risk-free premium there provided by the 10-year yield just isn't what it used to be. So their whole, you know, targeted strategy has to lean more heavily on the equity side than it usually does. So all of that together says that we should, you know, finish the year with a lower mode and median on the VIX itself. Looking here at VIX futures term structure, this is another one of the tools that I look at, which basically takes us to the year end. And right now you've got the VIX here at 14, and you have futures, whether it's the November or December, continuing to converge down. Now, the slope of the curve is the most important to me. Even when I change the angle from narrow, this is about the steepest we've had. Sorry about that, it refreshes. But this is about the steepest we've had, whether I do narrow view or wide view, I would say in the last 6 months, which tells us that the VIX downside pressure is more prolific near term, according to the futures market. The futures market is going to converge over the cycle of 30 days onto the spot cash VIX price. So the shape of the curve is quite indicative of what the futures market, or, you know, implied volatility, is telling us. So, and we still haven't even hit the mode. A lot of people refer to the VIX and they go, oh well, it's a mean reverting instrument. And this is a colloquialism that has just been accepted for the last 25 years, but it's a farce. It's not really true. The VIX is actually a mode reverting instrument. It spends the majority of its time in and around 12 and a half. So it'll spend a good deal of time around 13 and 12, a little bit less in 11. We can look at, the history here, and we can see the mode, historic mode is 1242. When we look at the chart here, you can see 9.05% here around the 13 level, 6.93% is the 12 level, so on and so forth. But everybody always refers to the mean 1928. It just doesn't spend a whole lot of time there at 1928. The majority of the time it spends around here. So I was listening in, Dale, on the conversation earlier on the VIX, and you'll hear it all the time on CNBC. Well, the VIX dropped below 16. It's getting cheap now. It's time to take out protection. That's where guys like me come in and go, there's another, insurance policy that's going to be voided pretty soon, because usually the VIX wants to and needs to basically achieve its mode at some point. So from 16 down to the 12s, there's a lot of premium you lose.
A lot. Well, options are like relationships, and 90% of them expire worthless. And you do have a lot of decay in a lot of the VIX products.
Exactly.
I actually have a question from Scott, and he says, so are you using the Contango as a tell? If so, how are you using it?
So Contango is a useful tool, but so far as guiding my trading participation, I short volatility through the leveraged VIX exchange traded products such as UVXY or TVIX or VXX. But my strategy is such that the most critical part of the strategy is allowing myself duration, giving myself or affording myself the greatest amount of duration to benefit from the inevitable. And the inevitable is that on any VIX spike of consequence, it has to eventually alleviate and come back down. So depending on how much exposure I have, that's how much duration I have to benefit from the inevitable. Now, using Contango as a sub tool within the strategy, I do, and I tend to have what I call the 5% rule, 5% Contango rule. And the way that works is, and it's also predicated upon the shape of the curve. Now, when the curve is relatively flat, so right now, if we look at the curve, we see the front month contract distance to the back month contract is pretty steep at $2.70. And that's why the front of the curve looks as it does right now, and why I said earlier, we haven't had this much steepness at the front end of the curve in quite some time, especially this far out of expiration. We still have 28 days until the November futures contracts expire. So I like the shape of the curve primarily. I have duration to benefit from any short positions that I put on, even if the VIX spikes. But Contango is above 5%. At 5%, I often, inform my traders in our premium member group, this is an ideal opportunity, as long as you have your, the right position size, to start a short volatility position. Goes up to 10% Contango. Again, the 5% Contango rule. For every 5%, the odds increasingly are in your favor for additional VIX exchange traded product decay, to ensue. So at 10%, we would add another position. At 15%, another. So it is part of the guide, or I should say a subset of the tools that guide the overall strategy of shorting volatility with duration.
Shorting volatility and writing options have some similarities to me. And, I guess the key question is, writing options at times could be like picking up quarters on the sidewalk until the steamroller comes down the road. And we had a steamroller event in volatility products. When was it, Seth? 2 years ago?
February 5th. Yeah, February 5th.
Okay, so how were you in a position, and how did you manage risk when you had, an exogenous event like that?
So I've been doing this now for this will be the 9th year. So leading up to that, so here's my article, Short Volatility Strategies and a Word of Caution. So to your point, Dale, the volatility event, the biggest spike in volatility in a single day happened on February 5th, 2018. I wrote this article on November 19, 2017, basically warning folks, about how overcrowded the trade was back then and some of the specific instruments within.
Okay, how do you know it's overcrowded? I mean, we have COT
Right.
for knowing things in certain markets. How do you know when positioning is extreme in VIX?
You can look at COT obviously from the commercial and the non-commercial side. You can look at
In
options
VIX?
chains. I'm sorry?
There's a COT report on VIX?
There's for non-commercial and commercial VIX futures.
Oh, I see. Okay.
As well as options, the VIX options itself.
Okay.
But more importantly, you look at the open interest on the individual ETPs.
Strikes not in the options, the open interest on like TVIX and UVIXI.
Correct.
Okay.
And going back to those dates in 2017 and through the year end, you could see the open interest was just extreme. In fact, I think it was back then that TVIX actually created more shares. They create, shares every year.
Yeah, reverse splits.
This was more of a demand side equation than it was anything else so far as balancing the fund. But in terms of, getting back to your question, how do you avoid situations like quote unquote Volmageddon? Well, that's where I fall back onto macroeconomics and just understanding the general rule of thumb that volatility moves in regimes. We went from a low volatility regime in 2017. We were looking at a Fed tightening cycle in 2018. More than likely, the greatest probability from an ultra low volatility regime is that you would have some mean reversion higher in the next calendar year. And that's exactly what happened. So I was able to avoid, any severe damage from that volatility event, mainly because I had the right macro outlook and understanding of the probabilities in 2018. Now,
so
after that,
you were flat.
I did have some flatteners. Yes, I did have exposure. All of 2017, I had the 2X instrument, which was UVXY. At the tail end of the year, I took that down to a VXX, which is just a single leverage instrument. So it just doesn't move as much. You don't get as significant gyrations or risk with a VXX as opposed to UVXY or TVIX. And I had flatteners on as well, so that in the event of a more precipitous spike in volatility, I just wouldn't see the drawdown that most people would. So it's about the macro outlook. It's about understanding the nature of volatility, understanding positioning in the complex as a whole. You can avoid a lot of these, and that's what we teach people and educate folks on at phenomgroup.com.
Do the technicals of the S&Ps come into play in your decision about VIX? Is there any subjectivity about what you see market structure wise that guide you for what kind of strategy you're going to execute in VIX products?
Minimal. As I mentioned, primarily it's a duration strategy to short volatility. But there are times that, we'll look at overextended, markets. We'll look at RSI and things of that nature related to the S&P 500 specifically to, kind of give us, maybe, the probabilities of a near-term market retracement and a possible uptick in volatility to maybe reduce some exposure, take some profits and, reapply to those same positions at better prices.
Okay, what are you doing in here with this pretty comatose action in the VIX? Same thing, duration, trades?
At this time, I'm looking at the S&P 500 possibly achieving, a new high and I'm in the process of, basically just taking profits. We have had a larger size position in UVXY for the last 4 or 5 months, and now with UVXY hitting all-time lows, with the S&P 500 on the verge of possibly achieving a new high, this is an ideal time where we would be reducing exposure, taking our profits, still keeping some exposure on, because you never know exactly when that next volatility spike will occur, or how deep the decay in the VIX will be. But basically giving ourselves a little more cash to participate in the future and look at other instruments.
You ever do anything to take advantage of a price move to the upside in VIX?
It takes a good deal of market timing. You have to also have the right instrument, take the right strike in the option, the right premium. Yeah, very rarely. At best, we have a strategy that we call long against the box. The box is our greater or our bigger short position. And if we see a sustainable, multi-day probability for the VIX to head higher, we'll take out, so UVXY would be the short position. We'll take out a small hedge using a TVIX long. So we call that the long against the box strategy.
Okay. So what do you shoot? Go ahead.
An outright long on volatility? No, you got to time the entry and the exit pretty well.
Okay. So what do you shoot for on a per annum basis, return on investment or return on equity, using that strategy? What have you achieved over the last few years doing this?
So since it's became my primary strategy in 2012. So we've beaten the market every single year, average returns around just under 50%. This year, we're up 42% right now. I often post my brokerage account actually on my Twitter feed so people can check it out. And, but yeah, I mean, it's above average returns.
That's fantastic returns.
Thank you.
Yeah.
I trade a lot of retail stocks as well, as part of the, the collective, portfolio.
Stocks in the retail sector, or just stocks?
Correct. I used to be a sell side analyst covering the retail sector specifically and consumer packaged goods. So companies like Target, Bed Bath & Beyond, Walmart, Coca-Cola.
What kind of Christmas are we going to have, Seth?
It's going to depend. I mean, because as you probably, talk about quite often is what's the next tweet? As of right now, things look like they've de-escalated a good deal. And there's some quote unquote promissory notes out there for a phase 1 deal to be signed. However, if that doesn't come to fruition and it actually does a 180, so to speak, then I think you're going to have a sentiment shift once again in the market. And as we saw last year with a number of issues, you had the Fed hiking, you had the market downturn, New York property real estate downturn, and threatening of a government shutdown basically play out in the economy. And we saw it in December retail sales.
Yeah, what an ugly break that was in the market last December. I think I heard Elvis singing, "It's gonna be a blue, blue, blue Christmas."
Well, I'm not going to piggyback on that.
So everything really, do you think that the trade deal is bigger than the Fed?
No. I think the Fed has more tools in their bag than the media speculates upon. But we don't need anything creating a headwind. Let's put it that way. And I think you get 2 bad Christmases in a row, and the market doesn't necessarily recover from that in the out year. That's the bigger problem. It's okay, you get a 1 bad Christmas, which is what we had so far as total retail sales last year. But if you repeat that when it's already something that investors as well as consumers are concerned over, seeing how the recency bias plays a role in sentiment, then it's kind of like, how many times are you going to fool me? And that
Yeah,
can be a
'cause-
self-fulfilling prophecy that plays out in the economy next year. And I don't think that is something that either the White House or the Fed wants to see happen. So I think
some guy that represents retail that they interview on CNBC all the time says that retailers are already cooked.
cook so
and-
far as inventory or
Cooked as far as what the higher prices they're going to have to pay because of the tariffs and margins,
yeah, well, there's
etc.
been, yeah, the front loading has been amazing. The front loading has been amazing. And, I don't put it past the White House I don't put it past Larry Kudlow to understand, as long as they keep a certain level of fear out there at the corporate level, they can still achieve the consumption growth that fuels this economy. So, in other words, the dialogue, the tweets, they seem to, have this sustained elevation that provides sustained CEO sentiment, which is, pretty dire at this point if you look at the charts. And that basically fuels the front loading. But they can't pass that along to the consumer. So the consumer's numbers and the actual retail sales continue to look good throughout the year. And we just had a hiccup in September with the September 0.3 decline, 0.3% decline. But the rate of change here, when we look at the rate of change, because that's the most important thing. That's the biggest headwind we have in 2019. People look at the earnings, we're in an earnings recession. The reality is the comps were too high last year. You're not going to comp to that in the next year, but now we're setting up a low bar. When you look at PMIs and everything last year, well, all the front loading that happened before the July tariffs went into effect created these elevated PMIs that you just can't get back to. Mm-hmm. So it's this, and then you got to work off all that inventory as well over the next 6 months. And I see a lot of that play out in the retailers. I used to work for Target. I was an executive at Target for some 8-9 years. I visited, we used to travel to China, Cambodia, Vietnam, all of the Asia Pacific countries looking for something that wasn't and could scale, a production line that wasn't in China. The problem with doing that is, and we signed a deal with this company in Thailand. This is Target. We went to, it was a textile, a private label that Target was looking to move away from China. And we went to Thailand. We found somebody that could do it. So when we finally get, the purchase invoice and all of that good stuff, and the contracts were just about to be signed, what do we find out? We found out that this was a Chinese JV. It was a joint venture owned by China. So you can't quite get away from that situation. But the other alternative is for retailers to basically, as you said, cook and front load, buy all the inventory, get all the product here before the tariffs go into place, to avoid, an increase in the tariffs, and still not have to forcibly pass along, the increased costs to the consumer. Now, what we are seeing, though, is certain costs are being passed through, but it's on the retailers follow an 80-20 rule. 80% of their sales come from 20% of their goods. So where they get the greatest volume, and they know they have to have items like toilet paper, that's where the prices go up. They can afford to, basically pass it along on toilet paper. They can't afford to pass it along on this brochure, this decorative pillow that doesn't have the same volume.
Interesting. Great explanations. And really appreciate you being here, Seth. What's the best way for people to get in touch with you, follow you, your Twitter handle, your website?
Yeah, so here's our website, phenomgroup.com, spelled with an M. It's kind of an acronym for financials and phenomenal, because we tend to, generate phenomenal returns for all of our members. We have a trading room. We have trade alerts. Most important is our weekly research reports, which guides us every single Sunday. It comes out every single Sunday. with our expectations and our broad-based analysis, everything from all things related to the S&P technicals, all things related to the economic data that came out in the week and what we can expect in the week ahead, fund flows, earnings outlook, and then of course, investor takeaways, our thoughts about the compilation of the research that we've, taken apart throughout the trading week.
Well, thank you, my trading warrior brother, for coming back and edifying us about VIX and how you approach it. And yeah, the choo-choo train's coming, and hope that the caboose is full of cash for you
Thank
and
you,
your
sir.
subscribers, and that you have a great finish to the year, and really appreciate your knowledge and your expertise in something that I have a hard time wrapping my head around. VIX products and crypto I could put in the same category. So anyway, Seth, thank you very much for being with us today. And consider
Thank
you
you.
my trading warrior brother. I tweet your stuff, and I'm glad our paths crossed on Twitter.
Me as well. Thank you. Have a great end of the year, and God bless.
Thank you, everyone. That's Seth Golden, and you could follow him. Seth, will you want to give your Twitter handle again? I believe it's Seth_CL.
Seth CL, capital CL, at Seth CL.
Okay, there's no underscore before.
No,
CL.
sir.
Seth CL.
Yes, sir.
For a cool looking guy. All right. So have a great one, Seth. Thanks
you
again,
too.
buddy.
Thank you. Bye-bye.
All right, everyone. So that's a wrap for Turnaround Tuesday. Euro pound's trying to make a move. We'll see everyone tomorrow. Good hunting the rest of the day, and don't just count your pips, count your blessings. And Gregorios, if you're still here, oh, you're welcome, Brock. Thank you. Barry, I think he said 50% return. And Gregorio, if you're here and you want to talk about what's happening in the funds market, please get a hold of me either through Forex Analytics or through Twitter, and we'll set it up. And that's a wrap, everyone. Good hunting. Adios.